the question that we're going to be tackling on this final panel for tonight is, what are investors really looking for in startups? And it made me wonder, what happens when you put a panel together of a venture capitalist from New York, a CVC from Switzerland, a couple of serial entrepreneurs, and a startup ecosystem specialist together? Now, they are going to be having an open conversation about funding, and we are all about to find out some very interesting insights. So, as I said, final panel of the night before we close for the day. Please welcome to the stage Corey, Brett, Andreas, Pascal, and Simon.
Let's see if we can keep it interesting. So, yeah, my name's Corey Wright, and I'm really happy to moderate today's panel with a bunch of really cool people from actually 2 different continents, if I'm not mistaken. If you want to be an honorary Texan, you can, Simon. We'll allow that. But first here on my left, we have Brett Martin, so managing partner at Charge Ventures. He was just out here a little second ago, but also a co-founder, which I think is very cool when you have the VC from entrepreneur path there. Also teach at Columbia Business School, as I understand. You've done some crazy things, like been a part of Vice when it started, and also sailed like 9,000 kilometers around the world. So beyond what I just mentioned, anything you would add? And also, what did you do that you really enjoyed this summer?
Well, I started the year afraid of heights. And then, since we're in Switzerland, I climbed the Munch and the Eiger in July. So that was pretty cool.
Wow, okay, nice work, yeah. So then, to his left, we have here Simon Fuhrer, CFO of Aliro. And as I understand, you just put together quite a large, it was 12 million round, so congrats on that. But also not your first gig, so you've grown companies from 50 to 100 employees. You've had some failed startups that you built as well. You're making a lot happen. You've got some real entrepreneurial experience. Anything you would add, and what did you do that you enjoyed this summer?
I mean, anything that I would add, yes, it's hard. It's hard. That's just like, all of it is hard. It's shiny, but it's hard. What I did like this year, I would say Zurich summer is amazing. The weather was good. I enjoyed a lot, but I also worked a lot because after the fundraise, there was a lot to do. So I'm just back from Houston, Texas, where we incorporated, which was also a great trip. So yeah, here I am.
Awesome. Thanks for joining us. And then next to you, we have Pascal, CEO, co-founder of Bloomhouse Ventures, but also a previous entrepreneur. What I love about Pascal is that he understands the value of bootstrapping. I think your first business, you bootstrapped to like 40 million, something like that. You're also launching a really cool later stage accelerator program. We talked about it a little bit. What else would you add, and what did you do that you enjoyed this summer?
Yeah, so you're absolutely right. So, and during summer, I also stayed here in Switzerland because I think summertime, when it is sun, you know, sometimes it could be that it is raining, but when it is a sunny summer here in Switzerland, that's absolutely amazing because you can swim in the lake and you can, in the same time, you can watch the snow on the mountains, which is absolutely incredible.
Amazing. Last, definitely not least, we have Andreas. You're head of M&A at the Axpo Group, but you've also done a lot of work also, I think, in VC, venture capital in general, a large background in finance. You advise a lot of startups, you're on a lot of boards, do a lot of work in the Swiss ecosystem. Anything else you want to share with everyone here today? And Gars, same question. What did you do that you enjoyed this summer?
So I get the only personal thing to add is, I guess in a month I'll be 10 years in Switzerland, so I'll be applying to the Swiss citizenship. I have the German one, the American one, so I'll go for the Swiss one. Yeah. And this summer I went to Greece with the family. Amazing waters, so highly recommend going to Greece.
Nice. Sounds amazing. My highlight was I took my mom from the US, who's never been to Europe really before, to Verona, Italy, and she had a great time. So that was fun. And she babysat the kids, so my wife and I got a date. That's always good. Okay, but that's not the point of today. What's today's topic? Today's topic is about what are investors looking for in startups? And I thought we'd switch that question around because you could say a lot of things, right? And a lot of people have said a lot already on that. So let's switch it around. Anyone who wants to go first, go ahead, and you guys can just sort of chime in on this. what scares you away from a startup? Like, what makes you run the opposite direction if a founder shows up and does this or says that or has that on their pitch deck, whatever it is? What's making you run away and not get closer to a founder?
I'm curious to hear the guy's opinion because, you know, I'm the receiver of those emails. No, I'm not investing.
I mean, you can share what you thought they were running away from.
Most of the time, you don't know if it's true or not what they're saying in their emails. So,
yeah.
I mean, the truth is that investors are looking for any possible reason to not invest in your startup.
Yeah. Okay.
Your email's too long. It's got too much information in it. You didn't come through the right channel. You're too early. You don't have enough traction. You have a startup that people have already tried before. You have already raised money and now you're looking for a bridge round. Like in any possible context, all those things could disqualify you. And then in another context, any of those things would also be fine if your numbers were correct or you had the right pedigree. So sorry for the inconclusive answer, but there's lots of little details that investors are judging you based on.
Okay, fair point, fair point. Pascal, Andreas?
Yeah, I think I would add on that, that especially focus, so I want to really see that those people, those founders are really focused to their own startup, and also to customers and products and stuff like that. And often you see sometimes founders come around and say, yeah, I do have this startup, in the B2C area. Then I say, yeah, but we only do B2B. Yeah, but I do have another startup, which is focusing on B2B, And I think normally that's the time when I say, okay, is there really focus around? And that's where I normally, are scary, and will walk away.
So lack of focus over FOMO.
And just to riff on that, a huge pet peeve of mine is a lack of a sharp go-to-market. So particularly early stage founders, they come and they're like, who's the market? And then they have this stupid slide with like $50 billion on it. And I'm like, well, you're not going to sell to $50 billion of the market today. Literally show me who your first 20 customers are going to be and why. Is your product the best in the world for those people?
Yeah. So Andreas, corporate venture capital, same or different?
I think the worst experience I had was in Zurich, actually, a founder, Series A, 2 years old company or so, and all he was talking about was the exit. And yes, exit is important to the founder, it's important to the investor, but at a Series A stage, I think you should be thinking about building your company, building the team, and at some point, the exit will come. But to already plan the exit when you're super early stage, I think that it's the wrong focus.
Mm-hmm. Great. Awesome, thanks. So Simon, back to you, the current entrepreneur, the fresh entrepreneur here in a group of folks. So what do you see are the pressures of after you close a round, the stuff you need to work on? So I mean, you just raised 12 million. I imagine your VCs are like, go to work. So how's that going for you? What's your experience like right now?
So I mean, yeah, you get that money, you immediately have to go back to work, and you're in that kind of honeymoon phase, and everything is good. Everybody is like attacking you because they want to sell you something, and you need to make sure that you say no all the time, which you do also with like before fundraising, so you don't change anything in that. The focus topic, right? And then I mean, it's all about sales. We were at 1.7 million in ARR when we raised our Series A, and basically what we need to achieve is that kind of 2.5, 3x over year and over year again, and that's the pressure that you have. So everything that counts is selling the nice product that you've built. So basically that's what we do, brick and mortars.
Nice.
Already preparing the next fundraise?
So, and that's also nice, we have the publicity, we have a product. So we are doing drones for work at height. That's basically in a nutshell. And once you raise and you publish that, a lot of VCs and they start to build relationships, and they also have a sales process, those VCs. So you need to understand that they want to basically sell your investment or their investment into you as well. but it's not helpful to talk now to all those VCs that reach out.
It gets to the point of Brett before. Actually, I was listening, and that startups that don't need money often are the ones that then are sought after by VCs, right? So
yeah. So I mean, like everybody is reaching out. The biggest funds are reaching out. We are choosing very specifically people that we want to work with and that share our vision to grow. And then we would find options. But it also is a little bit contradictory because what we see is really from my opinion, is somebody who nails on getting things done. So we only raised our round because we got through an intro from a guy who our CEO met at a bus stop. So really, really weird story. 2 weeks later, the whole due diligence and everything is done. He just dropped the email in my inbox. I got to the analyst. They flew into Zurich, and then I just nailed it. 1 email a day, short information, short answers to their questions. Data room was prepared, everything delivered in time, and then they offered a term sheet. And now it's the opposite, because I didn't have that Series B data room ready. I don't have an articulated story for Series B, but they still they see our sales growth because I'm only talking about how we grew in this year, 2.4x. We might be at 3x by the end of the year. And then everybody's like, okay, now, but start raising your Series B. And I'm like, we don't run out of cash. We choose the partner that we want to work with. So.
Oh. Brett, you mentioned you see startups do a lot of dumb things after they raise money. Anything you would add on here, or is that maybe cautionary advice once you've raised your funding round? Don't do this, don't do that, or?
I'll focus on seed because it feels like that's most of the audience here. I think you raise seed usually on some sort of idea, right? You raise seed on this premise. You're selling a story, right? You're not really selling metrics, but most of the time you're raising pre-seed. And then people proceed to just say, okay, we're going to have enough money to run for 24 months, and we're just going to spend like that, as opposed to saying, okay, we're only going to use this money to test this hypothesis and basically hope that we find product market, do everything possible to find product market fit, and not ramp burn until they've found product market fit, right? Like, if you get seed capital, you have to keep parsing it out so slowly until you see the thing that actually starts hockey sticking, and then you start pouring on resources. You don't pour on resources to get the hockey stick. That's actually a confusion of the causation of how startups work.
Mm-hmm. Nice. Pascal, Andreas, anything you would add to that in terms of things to avoid once you get that check? Andreas.
I'm a corporate, so maybe early stage VC would be better.
So I think I think it's also a little bit depending on in which market you are fighting. So for example, when you look currently AI markets around LLMs, they are at the moment. I think they are raising every 6 months. So I think they need constantly raising because there is such a big competition out there. And you need a lot. You need a lot of money to build all those LLMs, to buy all those chips. So that's a complete different game. For example, for a SaaS company, like you were mentioning, where you can first get slowly and look after product market fit, and if you have then reached product market fit, then you say, okay, now let's now invest into scaling up like sales team and marketing and stuff like that. So I think it's really depending on in which market as a startup you are currently playing.
Fair enough.
Maybe something to add. I guess if you've raised a Series A, you already start thinking of Series B, and you need to hit certain milestones, right? Also to keep your existing investors, the new investors, Series A investors happy. Everybody knows a startup business plan is never going to be reality, right? But you need to hit certain targets, milestones, whether it's technology, the product, building out the team, right? Having a good second level VPs and so on. And so, make sure you have realistic goals and targets that you can hit so that also your existing investors then feel comfortable that when you do a 20 million round, they will do at least a pro rata. They're going to be supportive of you and then it's easier to bring in a completely new late-stage Series B investor.
I'll tag in on this. I think when people go out to raise seed and pre-seed, seed A all mean different things in different markets, right? But I think when a lot of folks go out to raise a seed in New York right now, which is a $2 to basically $4 million round, you need to have somewhere between 250 and 500K ARR to raise a seed in New York. And I think what the mistake folks make, and you have to have a decent team, and you have to have an early product that's capable of generating that revenue, right? And I think people will waste 15 slides trying to justify why they deserve seed financing, which makes sense because you're raising seed, so you think you should spend 15 slides on why you should raise seed. But what I like to see is that someone who, in the first 2 or 3 slides, gives me all the information I need to know that they deserve a seed financing, and then they spend the next 10 slides telling me how they're going to raise Series A, right? Because I, as an investor, I want to know, how are you going to make me multiples on my money? How are you going to 3x from here, right? If I'm investing at you, putting in $2 million on a $10 million post-money valuation, getting 20% of your company, what I want to know is how in 12 to 18 months, we're raising 10 on a 50 pre-money valuation, right? I want to know how you're 4.5xing my money. So actually, yeah, sure, check all the boxes for why you deserve my $2 million check, but then really show me how you're going to 5x my money.
Mm-hmm. I mean, that's basically also my advice to any young founder who has not raised yet. Understand the VC business before you go out to reach out to VCs, because if you don't know what your goals are, you will never raise, because you don't know how you're gonna tell them why they should invest, right?
Exactly.
And I think to add on that, it's also very much important that you also come around with a realistic valuation, So often, I see that often in pre-seed and seed, and I think probably you can agree. I don't know if it is in New York the same.
You say it.
They are asking such a high price in valuation, and they don't really think about how they can double this valuation for the next financing round, for Series A, for example. Yeah. And then they are coming and complain because they have to do a down round or just a flat round or something like that. So I think it is very, very much important that you understand how the VC game is working, and that you are also at the beginning, that you are very, very realistic. What is a good valuation which I can double, for example, for the next financing round.
And what you don't hear is the VCs that are passing on you because they're running this math, and they're like, it's a $30 million post money. What are they realistically? How are they, they're going to raise an A at a 50 post. I'm only going to get a markup of 25%. What's the point? I'll wait until the A, right? That's happening, and you're not hearing it.
Yeah. So VC economics, very important. CVC economics, similar, different? What would you say?
So it depends. So we don't have a venture fund, right? So we're not a CVC in that sense.
Okay.
We spend, we off balance sheet. But I think it brings up a good point about the difference in investors. So we invest in startups, or partner with startups, or buy startups because the product, the team fits with one of our divisions, right? We've got a business sponsor, and they want to work with a startup because of the technology, whatever, right? I think the big difference, and I think that's where startups need to be a little bit careful too with VCs. I think Pascal and Brett, they look like really nice guys, right? You trust them, but they're only there for the money, right? I mean, at the end of the day, of 10 investments they make, 5 or 6 will fail miserably. 2 or 3 will do okay-ish, and they're looking out for the 1 or 2 that will bring back the fund, right? And so there's a lot of pressure on the VC, on the startup to be kind of risky in their approach, because it needs to be a big success. If it's not a big success, then it doesn't work with the VC model. If you're a corporate, yes, we don't want to lose money when we invest in a startup, but we don't need a 10x return on the investment. Potentially the startup does okay, but it's generated tons of value for us, our division, the technology, whatever, or we can even buy it at the end of the day. But we don't put the pressure on the team to go shoot for the moon, which the VCs do, and which is fine. But I think startups need to be aware of that.
Yeah, and that brings up a topic. I mean, like, this is in the startup owner's manual, right? He says, are you a scalable startup, or are you a saleable or sellable startup? So any of you want to chip in there, like, as a founder, how do you determine if should you go more the corporate route, maybe a little bit different growth path, niche market, fast exit, or acquisition target, versus scalable? What are your thoughts, or what have you observed with startups, and how founders can sort of evaluate that decision in terms of the type of fundraising strategy that they go after?
I mean, I think the premise of venture capital is a rapid creation of value in a very short period of time, right? Like that is the entire reason for the asset class. Otherwise, you'd be doing private equity and you'd be levering up businesses with like regular cash flows, right? And so, like, that's why I think the why now is a very poorly understood concept for founders, right? And the reason why now is so important for VCs is, like, if there's not a why now, then it should have already been being done, right? Why now is what created that dam break that now all of a sudden value can be created, really quickly. And so if you don't have a really compelling why now, then you might not actually fit in a venture investable asset class, for example. And then you might want to go, another route, a more kind of steady bootstrapped approach.
Fair enough. Simon, I a little bit teased something you told me earlier, so I stole it. But I loved your approach to how you went after different classes of investors. Would you mind sharing that maybe with the founders here, and what the strategy was for your last round and how you went about that?
I mean, this is not about like corporate VC and venture capital, because we also had this kind of trade-off in our process, because all the big oil and gas companies like Chevron, BP, their venture funds, they wanted to invest into us, which is a good proof for it's working and the industry needs it. But like our process in fundraising was really like that kind of playbook process. So before Christmas, and I learned from you in your talk, before Christmas is the worst time. We went out in October for our Series A last year. And then, because I only started at Valero in October and built everything up, November was the first reach out. Before Christmas, everything was like, oh, everybody was like interested. We had the first like DD entries. Christmas, first week in January, all our open processes failed, and we went into second-tier investors, and then first-tier investors at the last time. So we really learned how to pitch and how our material looks like before Christmas. Then in January, we modified, and then it happened that Cherry Ventures appeared on the plan, and we were so in the process, everything was ready, we could just nail it. So I always recommend to, go to 50 investors first that you might not have on your top priority list, and learn how to pitch it.
Practice.
Then second, you do it with those that you really want to work, and your absolute 5 to 10 favorites, you keep it for the rest, and you really try to find an entry point, either by luck, you can enforce luck, or you basically find other entrepreneurs that are in their portfolio, or friends or family, or like however you get access to them, and then it will happen. But persistence, learning on the process, iterate fast. That's my advice.
Amazing. So Pascal, since we're getting close on time, before we take some questions, I told you I'd ask this question. You love truffle hunting. How do you compare truffle hunting to startups and entrepreneurship?
Yeah, right. We were having this discussion when we were doing the interview together, So I think, I learned my dog, I do have a Labrador. I learned my dog to truffle hunt. And I think there is similarities with VC, with venture capital, because it's all around the ecosystem. You need to know where you are looking for the truffles. So, for example, truffles, they want to have like a stony, loamy, soil, that's very important. And when the soil is not having this condition, you don't find truffles, So it's the same a little bit like venture capital, if you climb up the Mönch, probably there you don't find a startup, but if you are close around to a university and where there is also like an incubator or stuff like that, the probability to find startups, it's much higher. So that's the analogy to truffle hunting.
Amazing, thanks. Yeah, it's like, the best entrepreneurs, found during like a depression or a, like an economic downturn, right? So stony soil, lots of analogies. Okay.
Have you ever been flatteringly compared to fungus before?
Startup fungus, it's the next accelerator. Okay, I can see it now. Okay, bye Pascal. All right, so let's go to some audience questions. And while we're answering those, for the last thing, I want you guys to share your call to action, like who should reach out to you for investment or for business or for whatever. And also one last piece of advice you would give to founders. But question on the stage, Ralph. Ralph here wants to know, do investors accept founders of pre-seed seed startups to work in a certain percentage as an employee on the side to pay the bill? So basically, can you be part-time founder? Anyone want to take this? So I see a no, I see a no. Lots of no's. Anyone want to say why?
I think I would add on, then you are not ready really to pre-seed and seed, then probably you are more like family, fool, and friends, so get the money from those, people. Until you really say, okay, that's going to be real startup, and I'm really going to focus on my startup, and I'm ready now to get some institutional and professional investors.
Yeah, skin in the game. All right, so what red flags are there for investors? I mean, you said like everything is a potential red flag. Any other ones that pop into your head? How about from the entrepreneur side? What were the red flags that VCs were telling you, maybe in that second tier when you were pitching?
I appreciate that investing is hard and it takes a lot of time to build a good deal flow, but wasting time in a second call with a non-partner, if you're interested, it's a red flag. So if the analyst cannot sell your company to a partner after the first meeting you had with him, then it's not going to happen.
Fair point, fair point. Maybe just to nitpick on this topic, how should founders do due diligence on their investors from the 3 investors here?
They do references with your portfolio companies.
Yeah. And you guys are open for that, right? Like if a startup would ask you, hey, can we meet someone you've invested in? You'd be like, sure, right?
Oh, for sure.
Yeah.
Normally we offer that, so we offer them, if you want to have a discussion with one of our portfolio company, feel free.
Yeah, awesome. Okay, next question. I think you guys can see it here. Most hilarious request startup ever asked for? Might have to think on this one.
I mean, Shervin Pershar, who was at Menlo Ventures, was like notorious for actually shaving the name of the company into his head. But that wasn't a request. It was actually like one of his like tools for selling. That's how committed he was. Is that he put the Uber, the Uber logo shaved into the back of his head. So I think honestly, like one thing that maybe people don't realize is that like in a really competitive deal, the art of selling for venture capitalists gets absurd. I mean, you're delivering cupcakes to people's house every day. You're flying across the country to deliver them the term sheet in person. You're getting the entire Sequoia partnership, on the phone call, to surprise the founder. You're having, Doug Leone like in the pool, like giving a video talking about, things. So like even the best in the game are actually like really putting themselves out there to win the most competitive deals.
Amazing. All right, so I think we need to wrap things up. So then starting with you, Andreas, piece of advice for founders and your pitch for what you're working on right now.
Piece of advice, difficult. I think, believe in your passion and work super hard. I mean, just work. Never give up. And it's always a sales pitch, like what Simon said. You're constantly in selling mode. Axpo, we're an energy company, so if you're a startup in the energy field, and obviously energy is quite broad, then contact us.
Awesome. Pascal.
Yeah, I think the advice I would give is really, even if you get the first reviews, you know, also from us, you know, reach out again, you know. So it could be that you have to reach out sometimes 4 or 5 times, you know, until you get probably, a yes. So don't be shy and ask again. And for the ones who want to reach out to me, so we are investing in B2B business models in the DACH region in early stage. So that means really pre-seed to seed. We do half lead, half co-investments, and the area of industry tech, clean tech, and B2B software.
Amazing. Simon, word of advice, your call to action.
So for early stage or entrepreneurs or want to become entrepreneurs, I always give the advice to don't speak a new learned language or customization. Do whatever the market understands. Copy as much as possible. Don't reinvent the wheel in terms of operations. I'm the CFO, so in terms of that, product should be innovative, but building a company should be whatever your investors, your stakeholders understand, because it will fail if it becomes complicated behind the curtains.
Awesome. Ask.
My ask?
You need employees, customers.
Yeah, do it. Just do it. Yeah, I mean, selling to employees as a good employer, selling to customers with a good product, selling to investors to have a good return on investment. Be a nice person, always, because it helps.
Amazing, thank you. Brett.
Cool, so ask is that we're launching a new beta product, and if anyone has interest and is trying to build their personal brand, just connect with me on LinkedIn and put personal brand in the LinkedIn connection. Piece of advice is that if you're a founder and you are just exhausted and you are, just really stressed and like worried and thinking you might not pull it off, my advice, my break glass in case of emergency book is a book called Endurance. It's about Ernest Shackleton's failed expedition across the South Pole. And if you read that book, if you're facing tough times, like this will give you the inspiration. And then my other little tiny ask is, I'm here for 2 days, what should I do?
Amazing. Well, I think everyone, you guys can help Brett with that, right? So thank you so much to all of you, Brett, Pascal, Andreas, and where am I missing? Yes, Simon. So thank you so much. And the rest of you, see you tomorrow. Have a great evening. And looking forward to connecting with you later.
Thank you.
All right.
Cool.